Hello everyone and welcome back. In our previous video, we had seen the components of financial statements, that is what all statements forms part of the total set of the financial statements. Number one, statement of financial position. Number two, profit and loss account and other comprehensive income. Statement of changes in equity, cash flow statements, notes to accounts, all these five statements for the previous year. And seventh one is one additional balance sheet or statement of financial position as at the beginning of earliest comparative period where there is a change in accounting policy, rectification of error or reclassification, which is material reclassification. So this seventh statement we had seen, out of which three things are new. Number one, concept of other comprehensive income, statement of changes in equity and the additional balance sheet, the seventh item, which is at the beginning of earliest comparative period. These three things are new under IFRS and Ind AS, which was not there under Indian GAAP. One of the most confusing line item or the statement amongst these three is the other comprehensive income. There are a lot of myths around whether OCI items are realized or unrealized. So should there be classification between P&L and OCI based on realization, or if it is unrealized? It's not true. Whether OCI is below the line item, it's not true. So we are going to discuss quickly today that what is other comprehensive income. So this concept of total comprehensive income, when ISB first introduced this somewhere around 2010, they said that we always present only transactional gains and losses by way of profit and loss to the users of financial statements. It may be investors, stakeholders, vendors, employees, etc. Transactional gains and losses means if you have entered into a transaction, sale of goods, sale of services, sale of any fixed asset or any other asset, whereby transaction has taken place and gain or loss has accrued. That is presented in the statement of profit and loss. Apart from this transactional, the transaction which has already incurred, there is a second category, which is the transaction has not entered into with respect to any asset or liability. However, underlying transaction is expected to occur in near future. So how the gain and loss is presented here? So asset and liability with respect to which transaction has not taken place yet. I have not sold it, I have not transferred it. However, that transaction is expected in near future. We call it as an underlying transaction with respect to that asset and liability. And if the transaction is underlying for that asset and liability, that asset and liability is expected to be fair valued with respect to respective accounting standard. For example, financial instruments. Some financial assets or some financial liabilities are expected to be fair valued on each reporting date. So transaction is expected, and that's why those are fair valued on each reporting date. Transaction has not taken place. It is underlying. It is expected in near future. So any gains and losses on fair value change will be accounted under profit and loss account, because even if transaction has not taken place, it is expected in near future. Apart from that, there are few more value changes which are there where there is neither transaction has taken place nor transaction is expected. We call it as non-transactional value changes. This is the basis for bifurcation between P&L and other comprehensive income. We need to be absolutely clear on this. This is the only basis whereby you can classify between, or where you can differentiate between the items of P&L and items of other comprehensive income. Standard has not clearly mentioned about transactional and non-transactional. This is interpretation. So transaction is transaction which has already taken place, or there is an underlying transaction which will take place in near future. Non-transactional value changes are the value changes with respect to assets or liabilities with respect to those assets and liabilities where entity is expected to do business and earn future economic benefits like property, plant and equipment. I am not expected to sell off my property, plant and equipment. I am expected to use that property, plant and equipment in business, earn future economic benefits. However, the value change might be significant. For example, a land and building which is purchased 40 years back in a developing country like India, it may cost 1 lakh rupees, but after 40 years, the value might have changed with respect to that land or building to 1 crore. There is a significant change in the value. The net worth has gone up. That value change, even if that is not transactional, there is not a transaction which has been taken place, nor it is expected to take place in the near future. Still, that value change is expected to be mentioned in the financial statement so that the users are aware of such positive value change and a positive impact of that on the net worth of that entity. Positive or negative? In our example, it's positive. It could be negative also. So both this positive and negative impact should be informed to the investor with that intention. My profitability will be comprehensive and it will be considered as total comprehensive income. So total comprehensive income is comprised of transactional gains and losses, that is profit and loss, plus non-transactional value changes, which is other comprehensive income. This is the concept based on which the statement of other comprehensive income is presented. In the reporting standard or accounting standard, IAS 1, these are the 5 line items which are provided by the ISB. Those will form part of the other comprehensive income. Number 1 is a revaluation surplus. What is revaluation surplus? Revaluation surplus is upward valuation of property, plant and equipment as mentioned in IAS 16 property, plant and equipment. Similar thing is mentioned under Ind AS 16 also. So Ind AS is no different than IFRS in this respect, in respect of OCI. Revaluation surplus. So now this gain is with respect to that property, plant and equipment which you are going to use it in a business, earn future economic benefits. There is no transaction which has taken place, neither the transaction is expected in near future. So any value change with respect to this property, plant and equipment, positive one, will be mentioned or will be accounted for under other comprehensive income. Number 2, remeasurements on defined benefit plans. These remeasurements in defined benefit plans are with respect to actual. So these are actual gains and losses with respect to change in the actual assumptions, your demographic or financial assumptions while calculating the employee benefit related liability like gratuity liability, pension liability, which is expected to pay off once the employee retires. So there might be a significant time gap. So there are certain assumptions on the basis of which actuary calculates this liability, which gets allocated as expenses over the number of years of his employment. So allocation of the total liability or total expenditure over the number of years of his employment is the expenditure of that year. So that may change in a subsequent year based on change in assumptions. That is not expected to realize in near future. So you don't know when that employee will retire, and that's why it is parked under other comprehensive income. Then FCTR, foreign currency translation reserves. That is, if there is a parent entity which is located in one country and has subsidiaries, associate, joint venture in other countries, parent entity is required to prepare consolidated financial statements in its own presentation currency. Subsidiary, joint venture, associates will prepare financial statements in their respective functional currencies. You cannot use that financial statements which is prepared in their functional currency to consolidate in your financial statement, because both the functional currencies might be different. So you need to convert it. So let's say your subsidiary is preparing the financial statements in US dollar, you are preparing in Indian rupees. You cannot use as it is that financial statement for consolidation purpose. So you need to convert that as per the principles of IAS 21. Now, assets and liabilities will be converted using closing rate, equity at historical rate, and profit and loss account at average rate. Difference will be there, but that is not expected to realize. That's not expected to have a transaction. I'm not expected to sell that subsidiary soon, and that's why this is not a transactional gain or loss. This will have to park under OCI. It has nothing to do with the realization. But you can notice one thing, the items in OCI will always be unrealized. Even though the classification or bifurcation between P&L and OCI will not be on the basis of whether it is realized or unrealized, but this you can understand everything in OCI will be unrealized because there is no transaction yet, nor the transaction is expected to enter into soon in the near future, and that's why it is always unrealized. So by mistake I said unrealized, but don't get confused with that. The two items, subsequent two items, are with respect to financial instruments, so financial assets, and one is with respect to effective portion of the cash flow hedges. So if you have understanding of IFRS 9 already, then you will understand about equity OCI financial assets, where your intention is to keep that investment for the longer term and you are not expected to sell that soon. So any value change on that will be parked or will be considered as non-transactional and will be taken to other comprehensive income. And for hedge accounting purposes, whatever the derivative you remeasure, the difference in fair values of that derivative instrument will be temporarily parked under OCI because that is non-transactional. So whenever the transaction is there, it will be classified through P&L subsequently. These are the 5 prominent line items which has been mentioned by the accounting standard IAS 1 as a part of the other comprehensive income. If you have liked the video, please like it and share it. Do subscribe to our YouTube channel Film Pro Consulting. Thank you so much.